Nobody believed NVIDIA, a chipmaker could tech giants, until it did. NVIDIA Corporation's market cap, now $4.5 trillion, exceeds both Apple and Microsoft, making it the world's most valuable publicly traded company. Startups built on artificial intelligence promise are raising billions, even when many haven't made $1 in profit. OpenAI is valued to be $300 billion, but is projected to generate a revenue of a measly $12.7 billion. I say measly because the difference is huge. Despite its popularity, or even because of it, OpenAI lost $11.5 billion last quarter, according to analysis of Microsoft earnings by the Register. Even the CEOs themselves are admitting, this feels like something we've heard before. Permit me to use the word bubble. Mark Zuckerberg is saying, yeah, I think it's a lot, but it's going to be worth it.
I mean, didn't you just tell Trump you were going to spend like $600 billion? I mean, that's
I did, yeah, through 2028, which is
that's a lot of money.
It is, and if we end up misspending a couple of $100 billion, I think that is going to be very unfortunate, obviously. But what I'd say is I actually think the risk is higher on the other side. If you build too slowly, and then super intelligence is possible in 3 years, but you built it out assuming it would be there in 5 years, then you're just out of position on what I think is going to be the most important technology that enables the most new products and innovation and value creation in history. So,
with Hank Green here, we can see the bubble schematic. He's super worried, by the way.
It kind of terrified me. I'm going to show it to you as well. What a good little visualization we have on our hands here. How NVIDIA and OpenAI fuel the AI money machine. So very quickly, to explain, NVIDIA makes the chips that do the compute that creates the artificial intelligence systems. OpenAI is the biggest company that creates the systems that use those chips to create artificial intelligence systems that do stuff. That this is probably a bubble? They're saying, okay, well, there's demand for OpenAI's services. People use them. They're using them more and more as time goes on. But you can't say that at the moment the demand is outstripping the supply. There's plenty of supply to meet the demand. And right now, OpenAI, according, I think, to them, they lose money every single time you use one of their products. Like the amount that it costs to train and use the models is more than the amount that they are charging, even for their top $200 a month tier. Once you get your mind around this little graphic here, it doesn't seem like NVIDIA just thinks people are gonna buy their chips at the prices they're selling them. NVIDIA seems to think it would be better for our share price if we found ways to artificially increase the demand for our chips, like by paying the people who buy our chips to buy our chips, or investing in companies that buy our chips so they can buy our chips, or you're just investing in companies so that they can buy NVIDIA chips. It just seems messy. It seems like bubble mechanics to me, you guys.
But then we have Jim Cramer, who's in a different world.
The market clearly believes that OpenAI can afford to spend tens of billions of dollars on AMD's highest-end chips in addition to NVIDIA's chip. I know that I am a believer.
We have Paul Huter-Jones, who thinks if it's a bubble, it's a very small one.
Well, it's so funny because you'd mentioned that 54% of fund managers think that we're in an AI bubble. If it's a bubble, it's a small one. If you just think about, and again, how do you actually define bubbles? If you think about the bubbles of the past 3 or 4 decades, the Nikkei in 89, NASDAQ in 99, biotech 2000, just after 2011, 12, China 2007, all those were 400 to 600% gains. The NASDAQ's up 200% off the bottom. So I don't know whether we're going to blow off like we did in 1999. Is it possible? Are all the ingredients in place? I think clearly they are. For me, the one thing that you can never, ever forget is that a year from today, assuming that the president gets his wishes, that the Fed funds rate's going to probably be in the 2.5. You know, I think they would like to see it at 2.25. So I think 2.5, 2.75. Obviously, whoever the new Fed chair is going to have to be able to intellectually move that board, a majority of the board. He's probably, whoever the new Fed chair, let's say.
And Intel's former CEO saying, of course, we're in a bubble.
Yeah, a lot of things happening at one time. Yeah, and are we in an AI bubble? Of course, right? We were in an internet bubble. Of course we are. I mean, we're hyped, we're accelerating, we're putting enormous leverage into the system. That said, I don't see it ending for several years. I do think we have, an industry shift to AI, as Jensen has talked about, and I agree with this, that businesses are yet to really start materially benefiting from it. We're displacing all of the internet and the service provider industries as we think about it today. We have a long way to go.
Another person who seems quite certain is Ed Zitron, the famous podcast critic.
The big question is whether or not all of this AI spending is a bubble. I feel very safe in saying yes.
Yes. You have committed to failure. There is no doing this. If they gave every dollar just to Sam Altman, the guy who can't even tell you why you're giving the money to him, when you're like, what are you going to do, Sam? He's like, we're going to,
one day it's going to be really
intelligent.
powerful.
It could get agentic at some point.
No one else has a big business doing this. Even Claude Code with Anthropic, which is theoretically meant to be super popular, 33 million a month. Ugh. That's less than the Cincinnati Reds.
Finally, we have Jeff Bezos, whose company, Amazon, survived the dot-com bubble.
What I mean by that, if you go back, like the 90s had a biotech bubble, and there were a bunch of pharma startup companies that were designing drugs and using new techniques, and the world got very excited. The investment world got very excited. As a group, they all lost money, but we did get a couple of life-saving drugs. A bubble like a banking bubble, the crisis in the banking system, that's just bad. That's like 2008. And so those bubbles society wants to avoid. The ones that are industrial are not nearly as bad. They could even be good, because when the dust settles and you see who are the winners, society benefits from those inventions. They still get those life-saving drugs. And that's what's going to happen here too. This is real. The benefits to society from AI are going to be gigantic.
What I can appreciate about his perspective is he's saying, it's most likely a bubble, but society is still going to benefit from it, and AI is here to stay. So the question isn't just, can AI change the world? It's, will the money we're betting on it ever earn its keep? I'd like to remain neutral, but it's hard. Comment below what you think. Let's go back in time, revisit the 1990s dot-com era, as it gives us a useful template. Picture the late 1990s. The internet is new. Back then, businesses with .com in their names often attracted sky-high valuations despite little or no earnings. Price-to-earnings ratios of 80 to 100x, or worse, were not unusual. Today, we see echoes of that. The top 10 companies in the S&P 500 index account for nearly 38% of its total market value, but only about 32% of its earnings. This tells us that the S&P 500 is top-heavy and not well diversified. It also suggests investors are paying a premium for these few companies, likely because they expect stronger future growth. Economist Torsten Sluk of Apollo Global Management remarked, "The difference between the IT bubble in the 1990s and the AI bubble today is that the top 10 companies in the S&P 500 today are more overvalued than they were then. The PE ratio, or price-to-earnings ratio, tells us how expensive stocks are compared to the profits they generate, essentially, how many dollars investors pay for each dollar of earnings. That sharp rise reflects today's AI-driven surge, where investors are pricing in massive future growth, even though actual earnings haven't yet caught up. With the S&P 500 now at 37.1, nearly 81% above its modern average, the market is strongly overvalued. Another critical similarity: expectations. In the 1990s, the expectation was, the internet will change everything, which it did, but many companies lacked a sustainable business model and collapsed. Today, AI will change everything, and maybe it will. But how many companies will profit from that change versus how many are priced on hope? Another parallel: infrastructure build-out. In the 1990s, fiber optics, massive data centers, laying groundwork. Today, AI servers, advanced GPUs, hyperscale data centers. Building ahead of returns always introduces risk. Let's take a look at some bubble mechanics. First, returns are not guaranteed. Only 5% of enterprise AI projects, 300 plus, reported measurable gains. Source roughly via MIT study. Second, valuations are enormous. NVIDIA went from $300 billion to over $3 trillion in a few years. Third, investor concentration. So many high valuations stacked in few companies, startups, while revenue remains small relative to the hype. Fourth, inflated expectations. Many business models depend on breakthroughs, generalized AI, dramatic productivity leaps, that are still unproven at scale. So what happens when growth expectations meet reality? If you buy into everything will be automated tomorrow, you might lean into 10x returns. But if you see the bills, the infrastructure, the unproven stuff, you might foresee a correction. But here's the nuance. Not all bubbles end in total wreckage. Like Bezos pointed out, what should you consider as a viewer investor? There's always a risk. If you invest expecting immediate returns, you might get burned. On the flip side, the infrastructure bets being made now could pay off over decades if AI delivers. At the end of the day, you should probably just dollar cost average and consistently invest. Dollar cost averaging, DCA, is a strategy of investing a fixed amount of money at regular intervals, such as monthly or weekly, regardless of the asset's price. Here's the bottom line. Every bubble begins with a kernel of truth and ends when people forget that truth still has limits. If you want to stay ahead of where money and technology collide, subscribe and hit the bell. We'll keep digging into the stories behind the numbers, not just the hype, but what's real. Thanks for watching. I'll see you in the next one.